Hey everybody, it's Mike from Orderflows, and welcome to this video that I'm shooting on a question I got recently in our weekly group training session for users of my software was what to look for in the order flow on a 10-minute footprint chart. And this is a question, whether you use my software, or you use another company's software, you probably are asking, Mike, I watch your videos and, I see you using range-based charts, 30-second charts, 1-minute chart, tick charts, volume charts, but I'm more of a swing trader, or I have a longer time frame that I'm looking at. What should I look for specifically on the footprint chart, in a 10-minute chart? Now, whether you're using a 10-minute chart, a 5-minute chart, or a 15-minute chart, this is going to apply. This is not strict for a 10-minute chart. Anything within the order flow can be applied on a wide range of chart. Now, do keep in mind, I'm a big believer in this, that the information that's derived from the order flow is best used as fast as possible. As soon as you get something that looks actionable, you should take action. You shouldn't wait for, the 10-minute bar to close before you take it. But again, it's a different style of trading when you're on longer term charts as opposed to, a 1-minute chart. So that leads us into the next point. Are there certain things that only appear on a 10-minute chart that don't appear on, say a 1-minute chart? No, you'd be looking at the same things. I've created lots of different videos on sort of different things to look for in the order flow. But when you start looking at longer term charts, I think you can narrow it down into what you're looking for. So let's take a look at some charts here. Now, again, everybody trades different markets. Everybody trades, different time frames, and it's hard to really shoot a video that covers everything all at once, because there's so many different combinations. And I'm going to start here with this is a 10-year 10-minute chart. Now, the nice thing about 10 years is they generally move pretty slow, and honestly, I can't look at a 10-year chart on a 1-minute basis, because it just moves so slow. And I find that using a range-based chart, or at least a 5-minute chart on a 10-year is much better. So I'll use a 10-minute chart here, then I'll take a look at a couple other markets on a 10-minute chart. But basically what I look for, there's about 4 things when I start looking at longer term charts. And the first one, now again, these aren't in any particular order. It's not like a checklist where you start at 1 and go to 2 or 3 or 4. If any of these things start appearing on the chart, then it gets my attention and I go from there. So the first one obviously is a basic one that we all know, stacked imbalances. And a stacked imbalance is when you have 3 or more imbalances stacked neatly on top of each other. You can see right here, there's a nice stacked imbalance here on this 10-year chart, right? The 1 against 1550, 127 against 1881, 421 against 2051, right? Next bar went up, kept going, continued. Then went sideways, came back into that stacked buying imbalance and took off. Now, a lot of times on 10-minute charts or 15-minute charts, you're going to get a stacked imbalance, and the market's just going to hold. It's going to come right back into it. So, for example, let's take a look at an E-mini. When you start getting into these other markets like E-minis, during the cash session, what you're going to get a lot of, you're going to see like here, this is a stacked selling imbalance, and then the next bar, it just overlaps it quite nicely. Now, me personally, I probably wouldn't look at using order flow on stock indices, just because it's kind of volatile. Now, that's just me. That's not to say that you can't use order flow on it, but honestly, if you're trading stock indices on a 10-minute chart, you have a much bigger risk tolerance. You should, because obviously the bars are going to be they can be very big. Like you can see this bar from 45.21 all the way up to 42, so it's a 20 point bar. But stacked imbalances, right, lots of times, unlike here in the 10 years, right, where we see it just came in and then the market started running up, went sideways, came back in and started running up. A lot of times on some of these more markets that have more volatility, you're going to see them overlapping, right, like you see here. 95 against 3, 80 against 9, 371 against 71. Then the next bar opens up, trades around there, goes a little bit higher, and then sells off. Okay, so it's not that you see a stacked selling imbalance and right away you got to get short, right? Let the market start going in the direction of that imbalance. Personally, I like it when it happens in the next bar, but you sort of had this bar in between before the sell-off. And again, when I'm looking at a 10-minute chart, I think you're best served trading it during the cash hours. This was on Monday the 4th, right? You've seen a couple bars in here, stacked buying imbalance, but then it just went sideways, right? It couldn't go any higher. Eventually it started going higher, as you can see here. But think about it for a second, right? When you're on a 10-minute chart as opposed to a 1-minute chart, how many, you think you're going to get a lot more imbalances? No. Okay. And the sad thing is, if you're trading a 1-minute chart, you're going to, this bar is probably going to be just this part right here. So you got this nice actionable stacked buying imbalance that you can trade off of. But by the time the bar, it's a 10-minute bar, so it's got to close after 10 minutes, right? So you're waiting 10 minutes for this bar to close, and it had this nice, move from basically, 46 all the way up to 57, a nice 10-point move right after that stacked buying imbalance that you're probably missing out on because you're trading a 10-minute bar. I mean, that's my argument. Whether or not you agree with it, is up to you. But you'll notice how the market did come back right down to that stacked buying imbalance level. You had another stacked buying imbalance here where the market just blew right through. But again, one of the ways to play stacked buying imbalances or stacked selling imbalances is for a pullback to that imbalance. You just sit in there with a bid. And, if you could have thrown in a bid, in that imbalance, I don't know if you would have got it here. But, maybe if you threw it in a tick or two above, which is not uncommon, you could have had a nice trade. But, that's more of luck if you're buying it in here. You'd have to come in ahead. And again, I don't know if a lot of people would, because your stop would just be on the other side, just as if, you have the stacked buying imbalance here. You throw in a bid just above it, all right, and you stopped out here. But then you throw in your bid here. Okay, maybe you get it. And the market went up. Threw in a bid off this one, right? Again, here's another stacked buying imbalance. All right, and draw a line here so you can see it. Okay, this is the top of the imbalance. So again, if you're throwing in a tick or two above the imbalance on that, waiting for that pullback, okay, it came right down to that top of that imbalance here. Again, if you just one tick above, maybe you would have got it, maybe not. I don't know. There was only 13 lots traded there. Probably you wouldn't have got it. And the market kept going higher. Here was a stacked selling imbalance. But, it came back up in there. It sort of stopped, and then the next bar opened up, went a little bit higher, then traded down and went sideways. So that would have stopped you out. But again, so, the first thing I would look for, obviously, are stacked imbalances, whether stacked buying imbalances or stacked selling imbalances. Most order flow software out there will highlight to you where stacked buying or selling imbalances. Okay. Now, the next thing that I would look for, again, these are not in any particular order, are exhaustion prints. Now, if you use my software, we do highlight them to you. Okay. So, in the software, because I'm shooting this was a question that came up in the user training. The exhaustion prints, right? So I'm looking for a value of 5, okay? And you can see here, 5 or less. So it could be 5, 4, 3, 2, 1. Exhaustion print here, here, right? I don't see any on the upside. So I know that, traders are getting tired selling down in here at 120.12, right? Even though, it did trade 120.11 and a half. Every time it trades down into 12, there's not much interest. Okay, finally got through. Market went up. Again, at the bottom of these bars, you're seeing very thin volume. Now, 10 years is a market that you can see the volumes that normally trade. It's in the thousands. And you're just getting 5 lots trade, a 1 lot trade, a 1 lot trade. That's something that you want to be aware of, right? You could see, it's just not for today, but, you could look for them, on any day. Ideally you want to see them at swing highs or swing lows. Here we are in the middle of a move down. You're seeing exhaustion prints at the top of these bars. Again, this is a market that trades thousands at a level, and all of a sudden you're just trading 3, 5. Here's one at the high of the day, came back, made a new high by 2 ticks, and then had a nice sell-off. Here's one where it's just sort of hanging around this low, trades down here, then finally traders just give up, trades 3, right? Then you got a nice stacked buying imbalance in this bar as well. Next bar opened up, trades right in there, and then it's off to the races. So you got stacked imbalances, the first one. Second one, exhaustion prints. Now the next one is, it's kind of the result. You tend to see them after stacked imbalances, but it's called thin prints, right? And what that means is, in the two-way auction, there's the bid, there's the offer, okay? And when you get one side being very light volume, it could be 0 volume. If the market is 5 bid at 6, nothing trades on the 5 bid, everything trades at the 6 bid, the 6 offer, and the next thing you know, it's 6 bid, and then it's 7 bid, and the market keeps going up. So you can see in here, right, this would be an example, 4 lots trade here, right? Here's 6, 7. Again, this is a market where normally you're trading thousands of contracts at a level, and all of a sudden you're just trading 20, trading 17 inside the bar. Here's 23, right? The price above it, you trade 7,000, right? Just earlier when you're trading there, the bar previous, it traded 6,999, so 6,700 contracts on the bid, 7,900 on the offer. That's what, 14,000, 15,000 contracts, 14,000 trading right here. Then in the next bar, it only manages to trade 23, right? Because the market's down and starts getting bid up. But what you have is you have a very strong buyer coming in here, right? They're buying everything up. They turn it bid here. In the very thick markets, like 10 years, when you see these thin prints, pay attention to them. 33.67. Now, again, what's a thin print in one market might be different than another market. 33 and 67 in the 10 years, when you're trading 3,000, 4,000, 5,000 at each price level, is considered a thin print. If you're in, say, say gold, right? This is gold on a 10-minute chart. Let's open this up here so you can see, basically each price level you're trading double digits, anywhere between 20 and 60. So, having a thin print level of 20, or 15 is not valid. You're going to want smaller numbers, like here, right? You're seeing 3, 2, 7, right? And the market just keeps roaring up. Now, Euro currencies, right? Same thing, it's an exhaustion print at the high, right? Let's start looking at these things, right? You got an exhaustion print at the high. Again, if you're looking at thin prints, right, you're trading double-digit numbers, right? So looking at, something in the 20s or 30s is not valid. What you want to be looking for is volumes like this: 5, 9, 2, 0, 6, 2, right? As the market is going up, there's just not a lot of counter trade taking place there. Here's a stacked buying imbalance, but again, it's a stacked buying imbalance coming out as you're taking out the new highs, which is what you should see, right? You should be seeing stacked buying imbalances as you're taking out new highs. What I'm looking for on a 10-minute chart is not when we're taking out highs or lows, when we're within the day's range. Now, lastly, the last one I'll talk about is sequencing. And, we released the indicator, the Orderflows sequencing indicator. But if you have my software, it's built in there. My users are familiar with it. And what it is, you can see inside the bar, there's these green boxes or these red boxes, right? And what that is, that's order flow that's bullish in the bar or bearish in the bar. And again, it's not just about seeing it. It's about watching how the order flow is occurring around it and where to take it. Okay, I always talk about understanding where you are in trading in relationship to the day's range. Are you trading up near the high or down near the low? If you're trading up near the high, I'm always looking for reasons for potentially selling, right? I mean, sure, the market could keep going higher, but if I'm at the high of the day, sooner or later, you're going to put in the high of the day. And if this is the time where the market's going to react and start selling off, then, I want to be prepared. And oftentimes there are signs in the order flow very fast that, this market's about to fall over. Let's go to the E-minis. What's today? Today's the 6th. Tuesday, I believe we had that sharp sell-off right after the cash open. We rallied up. It's hard to see it on the 10-minute chart, but on the shorter time frame charts, you can see this coming down. Let me just change it to a 5-minute chart, just sort of give you a different perspective. 10-minute charts are one thing to look at, but when you're looking at a 5-minute chart, this is 10 years, okay, while that 5-minute E-mini chart is coming up. You're right here on the lows of the day, then you're starting to see the bullish sequencing coming in this bar. Obviously this bar, and the market goes up. We hit that swing high, you got an exhaustion print there, right? Then you got the bearish sequencing coming in here. Here's a stacked buying imbalance. Okay, that one didn't work. You come down, you make the new low. You got the stacked buying imbalance right here. And you can see how this market it's holding that stacked buying imbalance quite nicely. People always wonder, why does the market come back to this? Why do these bars just come right back to this 09 level? Well, that's where you had that aggressive buying earlier, right? You got your thin print, 6. I mean, look at these levels. It's trading, 3,500, 2,500, 1,600, 1,100, 700, 600, 1,000, 1,700, 1,600, 15. Only 6 trade here. So you know that this market, I'll say skip this level, but it moved through this level pretty quick. This is a 10-minute bar. It had a lot of time to come in and sort of fill in that volume, and it didn't. All right, it just kept going up. But you don't see a 6 in any of these bars. You don't see anything below. What's the lowest here? Well, here's a 27, 86, 25, 39. I'm not looking at these edges of those bars. I'm looking inside the bar. So 6, this is important, right? It's telling you this market's moving fast. Obviously, it's kind of the result of that stack of these imbalances. You can see how the market came back. Let's see if E-minis came back here. So let's just go back to, what day was I saying? Looking for the 5th here. But you can see, right, after we put in that high, you're seeing the sequencing, and the market just dropped nicely. Again, if you're looking at the 10-minute chart, you're just looking at one bar here, right? These two bars are put together from the high to the low. So, again, is it something that, a 10-minute chart? I mean, there's certain things in the order flow that you can apply, but really in my opinion, the things that you want to be looking for would be stacked imbalances, exhaustion prints, thin prints in the normal markets, I say normal market hours, or at least from the European open until the US close. In some of the Asian markets, yeah, you can trade. I do watch the Asian markets at night and do get involved once in a while. But those got, for me, it's strictly the E-minis. These markets, some of these markets, just not enough involvement from the bigger players. Like, when you start looking at YM, the mini Dow, in some of these markets, there's just not a lot of activity from outside players. Outside, meaning the institutional players, not us retail traders, but sort of the bigger traders that are going to help move the markets. They're just not there as much in the Asian hours, right? In the Asian hours, they're more focused on what's happening in in China, Japan. So stacked imbalances, exhaustion prints, thin prints in normal market hours, and sequencing. But again, when you get in the thin prints, you should understand the market that you're trading. Again, what it's considered a thin print in, mini Dow probably might not be a thin print in another market, right? Because there's different volumes, right? When you're looking at order flow, you're considering the volumes. So if you like this video and want to see more like it, be sure to hit the like button, and more importantly, subscribe to my channel so you'll be notified of new videos as soon as they're ready. So thanks everyone. Bye-bye.